Good morning, everybody. I'm going to give you guys a few minutes to get logged on. Good morning, everyone. Thank you for joining us today for 6 Barriers to Investment Success, our first quarterly webinar of 2023. Today, this session will cover 6 biases from the field of behavioral finance, how these biases affect decision-making ability, and the impact they can have on investment portfolios. We do have the Q&A feature available, so you can submit questions through that option. And if there's time at the end of this session, those questions will get addressed. You can also submit any questions to us via email at marketing@yoursummit.com, and I will display that email address again near the end of our session today. We have 2 speakers joining us today. Our first guest is Ken Parrish. As an advisor to financial professionals, Ken provides a valuable perspective in the areas of market insights, practice management, and portfolio construction. He consults with financial professionals to help them deliver better outcomes for their clients and grow their business. Ken has a wealth of industry knowledge and a deep understanding of Franklin Templeton investment solutions. Our second panelist is Brandon Schultz, and he is a senior account manager for Summit. Brandon has over 4 years of experience in investment industry and multiple years before that in banking and accounting. With this experience, he is able to bring knowledge to his clients in multiple areas of their financial lives. Brandon is client-focused and values educating America's workforce on how to improve their financial lives, as well as help them achieve their financial summit. And now I will pass it off to Brandon to get us started today.
Thank you, Riley. And we very much appreciate everyone on the call taking some time out of your busy day to join us. I believe today what we're going to go through is extremely important, especially after the turbulent year we just had in 2022 and really starting the year here in 2023. And I was thankful for the most part, and actually, really thankful that most of our participants that I spoke with were very understanding of the volatility that occurred last year. I really don't know if that's because of the long bull run we just came off of. So everyone's, maybe not quite as panicked. Maybe account values are up enough to where it doesn't make them panic. Or maybe it's just, something along the lines that we're getting more information today than ever before about what's going on. So maybe people are more informed. Really regardless of what it was, I was very thankful, but we still had, many that did have those moments of panic and that really didn't like seeing the value of the account going up or down as often as it was. We had people that maybe decided not to up their contributions or their deferrals into the retirement plans and, or even maybe stopped contributing completely. Most of that hesitation and fear really comes from our own internal biases about investing in the current situation we're in. And Ken, I know you have some great material that you're going to cover today on those biases. So let's go ahead and jump in.
All right, well, perfect. Everybody bear with me just a moment here as I bring up a few materials. I will start by saying it's certainly appreciated you guys coming out and spending a couple minutes with us. The discussion today, as Brandon and Riley have mentioned, is really around behavioral finance, investor psychology, if you will. Many of the financial advisors that I work with, I call them financial psychologists, not financial advisors. And the topics we'll cover around how psychological influences can certainly affect our investor outcomes. And so up front, I always like to say what I'd like you to glean from this today is hopefully to be a little better steward of investing as you walk through and understand how you may actually be your worst enemy in some cases in regards to investing. And so I think it's important to think about how the human mind makes decisions up front. Consider this. You walk to the refrigerator, maybe it's late night, you want a snack. You open the door and there are 2 options in front of you. The first is a nice salad, right? You've cut it up, it's there, it's available for you. And then your second choice is a piece of chocolate cake. I always kind of tongue-in-cheek ask, who's having the salad? The reality is the way that your mind's going to make that decision is your prefrontal cortex is immediately going to kick in and tell you the salad's healthier. Your doctor would certainly recommend it. Maybe your New Year's resolutions are still jumping around and your thoughts are, it's probably not the healthiest for me to eat. And then deep in the brain, something called the amygdala is going to kick in. And that is really stimulus. It remembers all stimuli that you've encountered in the past. And it's going to scream as loud as it possibly can, chocolate cake tastes great. And so oftentimes that stimulus can lead us to some different areas and maybe doing the wrong things. Now, it's important, right? Both of those areas of the brain and how we make decisions are certainly important. If you're faced with some threat, call it the primordial fight or flight response. But when it comes to investing, it can actually work the opposite way and can lead us to make the wrong decisions at the wrong times. And so the track that we're going to run on today is quite simple. We're going to cover the 6 largest behavioral biases. We're going to talk about behavioral finance. Richard Thaler, who's known as the grandfather of behavioral finance, in 2017 won the Nobel Prize in economics. And it's surprising because I think most think that Nobel Prize in economics should be around some investment strategy or some thought process that gets you higher return. This, of course, is looking to offer better outcomes, but it's really more about looking within ourselves and finding the things that may drive us to make the wrong decisions at the wrong times. The first bias that we're going to talk about, the first psychological thought process, is what's called availability bias. In essence, recent and traumatic events will affect our decision-making skills. I liken this to if you knew somebody who lived through the Great Depression, maybe it was a grandparent, or at this point, a great-grandparent, and for some on the call, it may be a great-great-grandparent. Was one of the most tumultuous times in the history of the United States in terms of investing. As you know, people were moving in with each other. We were selling eggs on the side of the roads. The drawdown was tremendous. Unemployment well above 40% during that time period. What you'll find is those that lived through that era, and if you knew them well enough, what you'll realize is you never knew where 100% of their stuff was. Because their fear of losing those things continued throughout the remainder of their lives. You may look at this picture and think, gosh, selfies, they're commonplace nowadays. What's the danger, right, in a selfie? And in fact, we probably fear shark attacks more than taking selfies. But here's what's interesting. Media outlets often, and in fact, every year we're moving towards the summer months, and I'm sure we're going to see them start popping up in our favorite periodicals and news programs about shark attacks. But you are 3 times more likely in the United States to die taking a selfie than you are of an actual shark attack. And why is it out there? Well, sensationalized news, right? I'm going to take you back to the 30s and the 40s. Back then, when you had to walk to the corner to get a newspaper, if you were one of the lucky few, they delivered it to your front door. There was an adage, and it went a little something like this: if it bleeds, it leads. And what they realized back then is that the most horrific, terrifying, and gory thing that they could put on the front of newspapers sold more newspapers. That hasn't changed today. Sensationalism and ultimately driving viewership is the #1 thing. And what that'll lead to is what I call perception versus reality. I'm going to take you back to 2008, another rough time in the history of our markets. It was the financial crisis. Some would call it the Great Financial Crisis, trying to liken those things to the Great Depression, down 37%. But here's a quick poll, and I want you to answer to yourselves. Were the markets positive or negative in 2009? Now, today, maybe we're a little bit more of historians. We've looked back. We've got that, but many of you also may have still reacted that the markets were negative. The perception was, as this lasted much longer than it actually did, and by March of 2009, we had hit the bottom, and from that bottom, we moved up quite robustly. And in fact, by the end of 2009, as measured by the S&P 500 index, we were up 26.5%. But if you answered incorrectly, don't be ashamed, because 2/3 of investors who are asked that question would tell you that the market was either down or flat during that period of time. I'm going to leave you with one of the things that I leave with everyone that I speak with, and it's quite simply this. Remember this golden rule. Your television set is not your financial advisor. It's quite simple, and you'll find that many rely on it for, updates, but they do put in what I would call their sentiment, their thoughts, or quite frankly, their advice. That's the advice that you shouldn't take because, of course, they don't know you, one, as an investor, or what your long-term goals are, or the outcome that you're looking to seek. And I will tell you that it does parlay a bit further than that. If you look out 30 years, the S&P 500 has averaged roughly 10.65%. That's through the end of 2021. We have not factored in 2022. I'm sure that our marketing area is rigorously looking at putting that data together. So maybe it drops 65 basis points, but still 10% over a 30-year time frame has been a rather tremendous run in the history of the markets. But what concerns us as financial professionals is that the average investor is leaving a little bit on the table. And in fact, it's roughly 3.5%. Now, on a year-by-year basis, that may not seem like a lot, but Albert Einstein once called compounding the most powerful force in the universe. And 3.5% compounded over 30 years is a rather substantial number, and certainly will change the way that you meet your outcomes, whether it's retirement, whether it's children in college, whatever your longer term goals may be. And so keeping that first in mind, and availability bias is certainly, I think, pinnacle in terms of making sure that you're making the right decisions.
Yeah, Ken, it is so easy to become negative about losing money in our accounts. And even as someone who does this for a living and have, been very aware of finances since I was little, I call myself a finance nerd happily, because at the age of 11 years old, I asked for a mutual fund for my birthday from my grandparents, and I was given it. So I've had, that mutual fund ever since. But, even as someone who has all this background, it is sometimes challenging to see my account value dropping. And one of the things that I've done just to help give myself perspective is I will go look back at account values from 3, 5, and even 10 years ago to see where they were at and add that perspective for myself, just to show me, it might be hard now, but look at what staying invested, what some people would consider short-term, 3 to 5 years, 10 years even, in my case, but look at what that's done for me over that long-term period. Ken, is there anything that you've done to help control that feeling of fear when you see your accounts go down throughout your years of investing?
Great question, Brandon. And I would say a couple of things. One is exactly what you mentioned. Paul Harvey was known to say, one of my favorite quotes from him, in times like these, it's great to recall there have been times like these. And remembering that this isn't the first time, this isn't an anomaly. Downward moves in the market are really a healthy part of the overall market cycle. And then two, I think it would be exactly what I alluded to. Tune out the noise. Really spend less time focusing on day-to-day incremental market movements, and really focus on longer term movements. It's always great to remember what the original amount was that you put in, or how often you're contributing and how far you've seen that account grow over time.
We really do. Yeah, no, we really do hope that, people that, if we get in those situations where we're, thinking about it or concerned about where the market's moving, we know that participants are doing the same. So, we really hope that, if you have these fears that come up or these moments of panic, you do reach out to us at Summit. We want to help you. We want to be a resource for you. And kind of, even if you do end up, making a move of moving it all to cash or anything. At least, we get to have a conversation about it first and, maybe add some perspective. But, I think that's some very good ideas there.
Great. The second, in the essence of time, we'll keep moving. The second that I'll talk about is herding, the herd mentality. Insert Warren Buffett quote here, right? The Oracle of Omaha, where he talks about being greedy when people are fearful, and fearful when others are greedy. It really rings true. And I will tell you that as humans, we have almost an uncanny need to be part of the herd and be like, I can't explain it any better than this clip that I'm about to show you. This was a candid camera clip from over 50 years ago. And we kind of drummed it up. We thought, gosh, nothing can explain our point better than this.
The gentleman in the elevator now is a candid star. These folks who are entering, the man with a white shirt, the lady with a trench coat, and subsequently one other member of our staff will face the rear. And you'll see how this man in the trench coat needs to maintain his individuality. Little by little, he looks at his watch, but he's really making an excuse for turning just a little bit more to the wall. Now we'll try it once again. Here's the candid subject. Here comes the candid camera staff, 3 of them at least. And this man has apparently been in groups.
It's really amazing, isn't it? These gentlemen may have been on that elevator numerous times in their life and knew exactly what was going on, but when faced with others faced in another direction, felt compelled to move in that direction. That thought process really goes back to markets since the beginning of time, really. We can go back to the 1600s, where it was tulip mania, or the roaring 20s, or the dot-com era, all the way through 2002 through 2006, where we've seen exceptional run-ups in the market. In times like these, investors often forget their risk tolerances, and they don't want to be left behind. They're certainly looking to make sure that they can take advantage of the upward moves in the market, only to see what happens in what we call bubble scenarios in each that we've all seen, and for that bubble to burst. And in many cases, the higher it goes up, they will revert to the mean or come back down to their longer term averages and bring things back. As you can see, none of those actually ended well. I'm often asked, with my years of experience in the industry, Ken, gosh, you've got to have, a secret. And I normally, tongue in cheek, kind of speak really low, and I get really close and I go, do you want to know the secret of long-term investing? Buy quality investments and hold them for the long term. It's much more boring than I think some people realize. And that's where success, because here's what happens with herd mentality. We, and of course, many industry analysts will follow flows. Those buying into the market, those selling out of the market. And so these are monies coming in and out of the market. And what you'll find is that normally at the height, think 1999, 2000, we saw an incredible amount of money that flowed into the market at the top of that cycle. Folks that didn't want to be left behind. And so money went into, as you would imagine, lots of dot-com stocks. At that point, they were trading at huge multiples to their overall earnings, but yet folks thought, gosh, I don't want to miss this. This was an era when we were reading articles about Microsoft secretaries driving Ferraris, right? It was an incredible time in the history of the United States. And then Fast forward to another time in history, which was 2008. And as we saw the markets go down precipitously, we looked at another chart, it was somewhere around 37% to the downside. Gosh, money flowed out at a pretty exceptional rate during that period of time. But I'll ask this question to you. Isn't that really the opposite of the golden rule of investing? No matter what level of investor you are, we know that the golden rule quite simply is this: we're to buy low and sell high. And unfortunately, this psychological nuance that we're all faced with as humans will face us to try and do the opposite, right? Be greedy when others are fearful, and fearful when others are greedy. There's an old saying, if you can look the bear in the eye, you'll be a great investor. And that's that at the bottom of market cycles, try and find what you think is a better opportunity, and the opposite of what the herd will actually do.
Yeah, I think it goes, to the fear of missing out. And I think that's just increasingly, more and more, I just in the last couple of years, crypto has been a huge deal. NFTs have been a huge deal. People are, putting tens of thousands of dollars into these what are non-fungible tokens. Sports cards have gotten huge, and it's just whatever is on social media at the moment that it seems like some of these bigger names are investing in. A lot of people will jump in because they don't want to be afraid of missing out on that. And the one thing I've always said, and I like how you show like that it's the opposite of the golden rule of investing. You don't want to jump in when things are high. You want to jump in when they're low and sell when they're high. But we always worry about, and I hear people all the time, some of my friends, I had to get into crypto. It was just you just had to. Everyone was doing it, right? Well, I don't have a necessarily problem with investing in crypto, but it's the people that go full bore into it and forget their actual retirement savings. There's nothing wrong with having alternatives as a small portion of your investment portfolio. Absolutely nothing wrong with that. But we have to understand that there is risk involved, and a lot more risk in those alternatives than these investments that you said, these blue chip investments that have been around for a long time, and we're not worried about them having massive drops in any given day period.
I couldn't agree more, Brandon. Once again, buying boring companies and holding them for the long term. The key really is to remain diversified. I'll drop this. If anybody out there's a book bug like I am, Sir John Templeton, one of the founders of my company, wouldn't allow anyone to manage assets before they read this book. It's called Extraordinary Popular Delusions and the Madness of Crowds. And it really delves pretty deep into that topic of herd mentality. The next that we're going to cover is what's called loss aversion. And that's that as humans, we are much more affected by the prospect of loss than we are the opportunity of gain. Think about this question and how you would respond. If you had a multiple choice, and the first one was 100% chance of $80,000. That doesn't sound terrible, does it? So 100% chance of getting $80,000, or the second option would be an 80% chance of $100,000. What we would tell you is over 80% of respondents would take the 100% chance of $80,000, and really only 12 to 15% of market participants can handle higher levels of risk. That is ingrained in us at a very early stage. And I'm a big fan of examples. And so if you're a Jimmy Kimmel fan, you might be aware of this, let's call it segment that he does every Halloween, where he asks parents to play a little bit of a joke on their children. And after a long night of collecting candy, door to door costumes. I remember I grew up in Florida, so they were sweaty costumes. So it was a rough evening, and you've got your reward, right? This bucket or bag of candy. And after you go home, it's usually a little bit late. And so maybe you have a couple pieces of candy, and you go to sleep with dreams of all the candy that you've collected. And Jimmy asks the parents to tell those children that by the next morning they've eaten all the candy, and talk about primordial responses. Here's how the children respond to that.
I ate all your Halloween candy last night. There's no more candy left in your pumpkin. It's just trash. Oh no. You ate all your candy when you went to sleep. Why do you think you ate enough candy last night?
No, I only had like one bite of candy. Is serious? When you test? Oh, good for you. Then you'll have a problem getting down here. You feel what's in there. A lot of that.
I know. I ate it all. It tasted so good, especially the peanut butter cups.
Any of you that have children or can understand those responses, but as adults, as we think about our candy, right, our nest eggs, what we've accumulated over our lives, we can be just that sensitive to those types of losses, if you will. Think about the dot-com bust. Once again, 2000 through 2002 was a rough market, 3 years of negative returns in the equity markets, depending on where you were at. We saw, once again, from some of the past slides, the exact opposite of what investors should probably do, and that's lots of cash was raised, and many just decided, gosh, this isn't something that I want to be a part of any longer, and I'll get out of the markets and I'll wait for them to get a bit better, and I'll move back in. The same happened during 2007 through 2009, and so that lesson wasn't learned. We see it through almost every market cycle. And as we move to what we would consider more cash-like instruments, money markets, things that have, let's say, lower risk and maybe a sense of guarantee in regards to that. And as an investor, you may think, gosh, I've outsmarted the market, right? So from 2000 through 2021, a mere 0.06% on an overall return. But if we factored in 2022 and maybe some higher rates that started to sneak around, maybe that goes up. But the thought process is, I missed all the volatility and I have more money than I started with. And so I win. And at first glance, that may actually be the case, but many investors don't factor in something that's a little nearer and dearer to us today than it has been in the past. And that's inflation adjustments, what I call purchasing power. And that is, gosh, $100,000 today is not anywhere near what it was 30 or 40 years ago. And $100,000 30 or 40 years from now will be worth much less than it is today. The price of goods and services continues to go up over time, and factoring in inflation in regards to the amount of goods and services, I call it the egg scenario, right? Today, I think it's more pointed than it ever has been at $8 a carton of eggs. But 20 or 30 years ago was a dozen eggs more or less expensive than it was today. It was less, right? 30 years from now, if you were a betting person, would you think that eggs would be more or less expensive than they are today? Ask yourself, how many eggs can you buy during retirement? And the thought process is, and most financial advisors, because it's a longer term average, will factor in a 3% inflation rate at minimum to make sure that your purchasing power remains the same during your retirement years. And so as we move forward, the next that we're going to look at is what we call present bias. And that in simplest is, gosh, can we put off today what will give us a better outcome for later? And in simplest, it's something like this. any of you are familiar with the experiment, if you will, the psychological experiment that went on years ago from a psychology professor, and I believe he was at Stanford, and they call it the marshmallow test. And it was quite simply this. They asked 3-year-old to 7-year-old, so younger children, to sit in front of a marshmallow for just 15 minutes, one marshmallow. And if they could refrain from eating that marshmallow, they would be rewarded with either a second marshmallow or a pretzel, right? If they weren't marshmallow fans. And so what they could put off today would offer them something greater in return. And ultimately what you'll find is that only 1 in 3 were able to refrain from eating that marshmallow. Many times as we work with financial professionals, you'll see that we see the same with clients today. Maybe it's a shiny new red sports car in comparison to whether or not we're going to make it to college or pay for our children's college. Or is it more important to put a down payment on a vacation home today, or keep saving to make sure that you have the income level that you're looking to have during your retirement years? In simplest, the percentage of respondents, as we've done a survey just recently, that pay down current debts in comparison to taking care of other goals, right, or saving for retirement, was quite high. And in fact, at younger ages, the thought process was, I want to take care of these things, maybe get the things that I'm looking for before I start my retirement. I mentioned the power of compounding earlier in the presentation. The more years you have to invest, the more ability you have to compound that. And if you're not familiar with compounding, here's my favorite scenario. So a couple of them, right? A penny doubled every day for 30 days. If you haven't done that experiment, it's a fun one to do. It ends well over $1 million. Or one of my favorites, if there's an Elvis Presley fan or two that are on the call, if anybody knows when Elvis Presley died, it was back in 1967. When Elvis died, funny enough, there were 150 Elvis impersonators. Fast forward to current times, and we're at roughly 1.5 million Elvis impersonators in the United States today. Yes, still today. Now, if we compound that out another 40 to 50 years, 1 in every 4 Americans will be an Elvis impersonator. It's amazing, right? That truly is the power of compounding. And interestingly enough, it didn't change much as we grew closer to retirement years. There are studies that have been done that will tell you that roughly 10 years prior to your retirement, there are heightened levels of anxiety within many. And so we start focusing on it. And yet daily expenses, current debts, doing things that are immediate gratification actually are by majority outpacing actually saving for those retirement years. As we break it down, here's what the results are. And this is quite eye-opening to understand that 37% of those 60 to 69 today have only saved $1 to $100,000 for their retirement. And even more alarming is that 35% of them have zero saved and plan to rely solely on Social Security as their number one source of income over that time. And so
this one's, Ken, this one's really powerful to me. I think it's extremely important. And one of the things I always hope, the main thing that I hope for is, of course, when we do, enrollment or education meetings, that people sign up for the plan, but that they at least start saving or increase their savings, because, the money's got to come from somewhere when you retire, and it's important to be saving for your future, regardless of your age. I knew a lady that would go into meetings with a blank sheet of paper and would ask people, do you know what your account statement is if you don't start saving today, what it's going to look like? And she just held up the blank sheet of paper, which I think it's kind of funny. It's a little tongue in cheek, but it's true. Even if you're in your 40s and 50s and you think, and I haven't started investing yet, there's really no time for me, it's already too late. I should just, go ahead and not worry about it. Well, no, you're going to have that blank sheet of paper for an account statement when you go and retire, and, at least you can have something to pay off a house, something to supplement Social Security for a while or bridge the gap. So it is very important. I think, this was one of my favorite groupings here of biases. So I'm happy we got to go through it.
Perfect. The next that we're going to discuss as we move through is one that might be pretty timely, given the market cycle that we're in today, and it's anchoring. And anchoring, quite simply, is that you're focusing on one piece of information when making an overall decision. As you know, I'm a big fan of scenarios, and so let's take a look at this scenario. And it quite simply goes like this. Imagine going to the home computer, maybe it's a phone today, and you're searching for flights. There's lots of applications and areas that we can do that. And you think, gosh, I'm going to take a vacation. And so let's get an idea of what the cost of this is. And you sit down and, well, to your surprise, the flight that you're looking for comes in at $400. And you think, gosh, that's not bad. And so you table that for a minute because you have a couple of things going on, but you come back to the computer just 1 week later, and the flights have gone up to $500. Think about how you'd feel during that. So here's a second scenario, though, and it goes like this. You sit down the first time, you're looking for flights, and the flights that you see, they're $600, and you think, gosh, that's a little more than I wanted, but if I have to. And so once again, you've got other things to do. And so you come back just 1 week later, and those flights have gone down to $500. What a different reaction we have mentally, right? Now they're on sale, and we've gotten quite same end number, but depending on where we started, your anchor in that scenario really affects emotionally how we feel about that decision. We did a survey just recently, and when asked during up markets, down markets, what the average investor expected as an overall return, by a vast majority, the expectation was somewhere around 10%. But as we delved in a little further, if we said, okay, what if the market's moving at about 20% annually, the investor expectation now adjusted up to expecting 100% of the market return at 20%. Here's a side note. We also asked a third question, and that was, what if the market was down 20%? What's your expectation in returns? And what's interesting is the average respondent was, well, we expect a positive 3% return. And so investors expect to outperform a down market by 23%, which is quite interesting. Oftentimes, it's about visualizing and understanding that this is a marathon and not a sprint. We look at returns. If you go in and you talk to a financial professional, or maybe you're on the website, you model your retirement, and it tells you need this much income and you need this much of a return over a period of time. And maybe that answer is 8%. When you log off or walk out of that meeting, what's your expectation of the next year's return? In many cases, it's 8%. But very few times does the market move. Keep in mind, it's longer term averages, which means 50% above, 50% below. That's the simple math behind it. And your return may look a little more like this. And although over this 30-year time frame that we're looking at, you may have actually dramatically outpaced your expected return or your needed return to meet those results. We oftentimes can anchor ourselves at what we call high water marks. For instance, after 2021, it was a very robust move in the overall market. We saw account balances go up, a recovery cycle from 2020, if you will, but that ended up being a rather positive year as well. And so as we opened that statement in December of 21, we may have anchored ourselves to that high water mark. And once we do that, when we see things revert to the mean, or come back down to what are considered longer term averages, the following market cycle may seem, well, it will trigger many of the emotions that we've talked about today, right? Doing the wrong things at the wrong times. Understand, once again, and understanding that it's a marathon and not a sprint to get to our overall goals, right? Or outcomes that we're looking for makes a great deal more sense. And so one of the last biases that I'm going to talk about is what we call home country bias. And that is that we tend to favor companies, products, investments, one, from our own country, but two, in things that maybe are near and dear to us. I want you to think about Texas and Oklahoma and investing in oil, which is many other, or in the oil fields, knew somebody who owned a piece of land, whatever the case may be, or let's come to Arkansas. Might be much more comfortable investing in a company like JB Hunt or Tyson Foods or Walmart that are based there. No matter where you're at, things can be a bit more different. No matter where you're at in the country, or depending on where you're at in the country, you may call this something different. It's a Coca-Cola, or it's a soda, or it's a pop, or certainly what sports team that you're going to follow. In many cases can be geographically driven, or of course, what type of pizza that you prefer. Chicago, New York, even some of the southern states, and gosh, in this area of the country, we can probably discuss barbecue, right? Is it dry rub? Is it wet rub? It doesn't matter what it is, but we have these biases based on that. And what we've found is that predominantly, even though the US as a part of world market capitalization, and so in essence, the business that is offered to the world, we are at 61% of world market capitalization, but the average investor is actually grossly overweighted at around 79% of domestic. Why? Much more comfortable with this. I always say the next time that you walk into your local store, no matter what it is, before you purchase the product that you're about to purchase, or what I like to call a vote, right? Dollars of votes. We learned that back in economics years ago. Before you vote for that company as the best product that you are, guess whether or not it was manufactured and that the company is domiciled in the United States or outside of the United States. And what you're going to find is you may be surprised in many of those scenarios. And in fact, stock market performance by country over the last 20 years, the US ranked 20th out of 44 overall markets. And in many cases, this slide does surprise many in terms of the performance where it's at. We talked about 10%. There are markets that have dramatically outperformed overall in terms of markets that are out there. Not sure what happened in Greece over this time frame, but certainly something that can potentially happen. And so before I pass it back over to Brandon to wrap things up, in summary, I hope that this discussion made you a little better steward of investing and offered maybe some insights into the psychological influences that can affect investor outcomes and of course your behavior. I'll say I appreciate you spending a couple minutes with us this morning. Brandon, thanks for inviting me, and I'll let you wrap things up, Brandon.
No, Ken, that was really good stuff. It's always amazing to me what biases or reasons we can come up with and convince ourselves of to keep away from this perceived risk, or to convince ourselves we should do certain things. And we want everyone to know that they do have resources here at Summit to help with these hard decisions, because they are hard decisions. There's difficult decisions and emotions at play. And we always say that it's best to leave those emotions out of investing, but we also understand that it's nearly impossible to do when you're looking at your life savings. So, as always at Summit, we want to help understand the goals that you have for yourself, for your family, for your retirement, and we really want to help you reach them. And there's often times where we can bring ideas to the table that can accomplish those goals that someone who doesn't do this for a living may not even know about. So Ken, again, thank you so much for pointing out these biases. Some of them even hit home for me. And again, thank you all so much for joining. And with that, I will hand it back to Riley to close us out.
Thank you, Brandon. I'd like to thank Ken Parrish and Brandon Schultz for their time and sharing this timely and valuable information with us today. And we would like to thank all of you for joining today's session. Please sure to follow us on social media if you have any questions from today's session, or if you would like to be connected to a resource at Summit, please contact us via email at marketing@yoursummit.com. But for now, thank you so much for joining us and have a great rest of your day.